Welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous. The banking industry stands at a pivotal crossroads as we approach 2030. While the past quarter century was defined by digital transformation, which brought unprecedented efficiency and convenience, it's also created an unexpected paradox: the loss of personal connection in banking relationships. In this episode, Michael Abbott, Senior Managing Director and Global Banking Lead at Accenture, discusses how artificial intelligence and emerging technologies will help banks bridge this gap. They will enable them to combine digital efficiency with the personal touch that defined banking's golden era. We'll also explore how banks can differentiate themselves in an increasingly competitive landscape where technology alone is no longer enough to win customer loyalty. The leadership of an organization will be at the forefront of how an organization can succeed or be a laggard. The path to 2030 will require banks to fundamentally rethink how they serve, engage, and deliver value to customers. As Mike Abbott reveals in Accenture's latest Banking Trends report, success will depend on the bank's ability to move beyond standard digital journeys to create genuine, personalized, and empathetic engagements that feel as natural as texting with a trusted friend. So, Mike, you've joined us for the last several years to discuss Accenture's annual report on banking trends. However, this year's report was constructed slightly differently than the past. Can you explain a little bit?
Yeah, Jim, we did something a little different this year. We still have the top 10 trends, but what we did, the questions we were getting from many of our clients now at the board level is, what do we think banking is going to look like in 2030? So what we did is we kind of did a past, present, future. We went back and we looked at the past and said, what has driven banking for the past 30, 40, 50 years in many cases? We looked at the present, what's happening with AI and digital, and what are consumers saying right now? What is our research showing? And then we painted a picture of the future. And what we did in this year's trends was we stepped back and said, what are the key trends that we believe will drive banking in 2030? And a little different than the prior years, we didn't just look at a theme of things that were occurring. We looked at everything. We looked at structure of the industry. We looked at products. We looked at experiences, technology, operations, talent. We went across the entire banking spectrum, from the structure of the industry all the way to how operations worked, and tried to paint a picture of what we think banking is going to look like in 2030 and the trends that are happening right now in clients that we believe are going to shape that.
You know, it's interesting. As opposed to a one-year view, you took a 5-year view, which gives us a little bit more flexibility, but things are happening so fast. And as you mentioned, one of the things that are happening as fast as anything is the whole world of Gen AI and AI in general. Your report suggests that by 2030, AI will actually help restore the human touch in banking that has been lost as banks tried to digitize their mobile banking apps and their digital apps to almost looking very similar. There's very little differentiation. Can you explain how this seemingly paradox of technology will help become more human?
Yeah, in fact, the title of this year's report, Jim, is "The Future is Back." And it's meant to say the future is looking at what occurred in the past. And I think the best way for your listeners to understand this is just, I want to describe my experience 30 years ago getting a mortgage. 30 years ago, when I went in to get a mortgage, my first mortgage, I walked into the bank. They filled out all of the forms for me, and they said, Mike, all I need is your tax returns. Can you give those to me? I gave them my tax returns. I came back the next day. All of the loan forms were filled out. They walked me through it and said, Mike, here's what you're going to be paying. Here's your monthly payment. Are we good? And I said, yes, I'll sign loans. I want to contrast that with today. The bank did the work for me 30 years ago. They helped me get there. What's a bank do today with a digital journey? They've outsourced all the work to me. I fill out all the forms. I have to go through this. I have to find all of it. I have to double check it. I get stuck in their journeys. I got nobody I can talk to. I can't figure out what's going on. So I become, as you and I've talked about before, functionally I can get through the thing, but it is a royal pain. I believe the future is going to look more like the past. The idea of journeys and websites will go away. It'll be back to, hey, Jim, you want to get a loan? Sure. I want to pull all your information in. Here it is. It looks good. Yeah. Can you just send you a link? Can you take a couple pictures of your tax returns? Oh, it's all filled out. Here we go. Isn't that a much better experience than what we've done today, which is outsource all the work to our customers? That's the future. I think the future is the past, except it's enabled by technology. That's the big difference.
Well, it's interesting, Mike, because as we look at this, the whole digitalization process in the banking world, from my perspective at least, my biased perspective to a degree, is that almost all the focus has been on the back office and efficiency as opposed to really making it more human, as we keep on talking about it. And in doing so, as you just mentioned, it pushes all the work back to the consumer and not using all the data that's available to make it easier. I mean, you look at the way that Uber works and the Amazon works and even Google and other apps that really have made it easier to engage, more interaction going on, more things going on that are not simply efficiency plays, even though they may be. How will the employee's role evolve as AI becomes more prevalent?
Yeah, and when you look at the bank employees, one of the big questions we get, and we went into it in depth in this year's report, is we believe about 75% of the roles in banking are going to change. But that doesn't mean that they're going to be eliminated. It means that they're going to change the nature of work. And the analogy I would give you, Jim, is back in the 1980s when Excel came out, every banker knew, it was VisiCalc back then, every banker knew that finance was going to change. People were going to use spreadsheets instead of doing them on paper. And everyone predicted the demise of finance people. I can assure you there are more finance people today in banking than there ever were in the past. And what I believe Gen AI is going to do is change the nature of how we do work. So let me give you an example. Take somebody that might be doing commercial loans. They can only do so many a day. But now imagine that they can take in dozens of commercial loans. They can use the technology to look through it, pull them all in, find the right points. We're going to use AI to make our jobs better. And the point you made around cost versus revenue, I believe the banks that truly take advantage of this will think very differently. They will not think of Gen AI as a cost play. They will think of it primarily as a revenue play.
It's interesting because it's getting out of our own way. And it really, one thing that we've seen as we've done interviews for the last 4 years now is that organizations, you can determine how effective they're going to be moving forward, no matter what size it is, based on the leadership. And leadership, we're kind of working against ourselves. We haven't had a bad year at any financial institution except maybe a handful of organizations. So we rest on our laurels to a degree. We can tend to do banking as we've always done it because it's never really derailed. But it has made, as you bring out in the report over and over again, made the lack of any distinction between organizations. As you mentioned at the very beginning, the human factor. We used to distinguish organizations based on how nice they were to walk in the branch, how well they knew me, how well they responded to what I had. Heck, it's the way we decide what restaurants we go to, what retailers we go to. But we've really become so based in what we used to always do and use the data simply to make us smarter. How do you think organizations will do better at not just making it more efficient, but actually being more empathetic to my needs, understanding my needs, and maybe using agentic AI to build agents that can help me do better as a consumer?
Yeah, so there's a bunch of parts that you've put in there. And the point number one you're making, and I couldn't agree more, is that as we become digital, it's a sea of sameness. Everybody is absolutely the same. We all have the same websites, the pages, the journeys. And when you look at the bank app ratings across North America, you'll find every single bank app is rated 4.8, 4.9. There's absolutely no differentiation, to your point, differentiation that used to be around the branch manager, the person who knows you. As we move forward, what I see happening is anybody that's spent a little bit of time with ChatGPT or any of these Gen AI agents, what you notice is when you ask it a question, it remembers where you left off. And that is the fundamental difference between the digital age and this generative AI age. And that's what banks are going to incorporate in. You opened it up with one of the quotes we have in there, which banking should be like texting with your best friend. Your best friend remembers what the last text was. What you're going to see banks do is use agentic AI capabilities to build out a memory of the customer, remember where you started, the last conversation you had. And working with a bank through a digital experience will no longer feel like a journey. It'll feel like a continuity of conversation over time and continuity over channels. In many ways, Jim, it's going to feel like it felt walking into a branch manager that remembered you and remembered the last conversation you had. In this most simplistic way, that's it. And if I can, there's one other thing you mentioned in there, which was about talent and what differentiates. As you said, many banks have become a sea of sameness. I think the number one differentiator will probably not be technology or any of the things we're talking about right now, but it will be culture. And what I'm seeing is the banks that have a culture of curiosity tempered with execution, I believe are the ones that are going to win, because we're all going to need to learn a different way of working.
Well, you know what? It's going to, as you mentioned about culture, part of the culture of most financial institutions is the avoidance of risk. And I've been in banking for 50 years, close to 50 years now. And it's been amazing to know that through that whole time, financial institutions were always afraid about talking to a consumer on an assumption basis. While Disney will talk to us all the time, assuming the way we're going to walk through their park on an ongoing basis. And while they may make some mistakes, they make so many right moves that you feel very comfortable with them. Amazon makes recommendations. While they're not always right, and there's examples where they've been very wrong, you get more and more comfortable in them making and helping you make decisions. One of the bigger hurdles I see happening is my major relationships, both on the personal and the business side for me, are with two relatively large top 10 banks. And both of them I know a ton about me as a consumer and as a customer. They have collected data on me from all sources, yet they never show me that they know me. And I think that's out of fear of maybe making a mistake. They may say something that they should know better. But yet my airline relationship talks all the time to me on a really personal level and starts to use data they've used and says, I think you're going down this path. Well, I can correct them if they're wrong. Is this going to stand in the way when it comes to innovation, when it comes to new product development, when it comes into agentic AI or communication or engagement, where only the best organizations, which may not be the biggest, are going to really take the step to say, I'm going to be comfortable enough to personalize the relationship and maybe make that small mistake every here and now?
Well, Jim, I think it's a paradox that's already there today, because when if you're on the wealth management side, you're already having a conversation with your relationship manager all the time. And they will have a broad-based conversation and go anywhere with you. But when banks, to your point, turn that into a digital experience, they lock it down in such a way that you can't go outside of the lines. I think that solving that paradox or cracking that paradox, allowing these new agentic AI tools to have conversations like you would have with a relationship manager within bounds, is exactly the things we're seeing banks test right now. How far can you go? And there's all these really interesting concepts underneath the generative AI technology, like called temperature. And you can drive the temperature of a model down to zero, which means you can guarantee it's going to have the same conversation every time. A bank will like that, but a person won't. So I think the question is how are we going to adjust the temperature of these models to allow them to feel much more personal, like the RM conversations you have today? And again, the future is back. We want to have the conversations we had 20, 30 years ago that some of us are still having, but the majority of us are not.
It's interesting because when you look at this, one of the other things your report discussed is the fact that platform providers really face an innovator's dilemma. The banks and their core providers, the relationship is becoming more and more fragmented because There's so many technology vendors out there today that are doing an exceptional job solving for individual problems. Maybe it's a new account opening, maybe it's dealing with customer care on the call center area. How do you see the role of technology vendors, both the core, but even more importantly, those individual organizations that are the fintech organizations that they're taking care of individual solutions? How do you see those relationships changing over time between, let's say, the big banks and the smaller banks?
Yeah, and Jim, you nailed it in that conversation right there. Is that many of the technology vendors were built off of call it quantitative information, solving quantitative problems, deterministic problems in their solutions, and they became very vertical and very specialized. But customers have conversations over channel and products, right? And they've become disconnected. So what I see happening here is one way or another, either the ecosystem is going to, or the banks are going to bring back a connected experience. So I think it'll be hard, but it'll be simple, meaning eventually you're going to have the concept of a digital brain, just like you have with a branch manager, something inside of the bank that remembers you. And then you're going to have something that orchestrates a connected experience across those channels in one way or another. And the innovator's dilemma for the ecosystem providers is, are they going to be the one that brings that together and makes it simplistic, or are they going to remain in their vertical solution silos and kind of pushed off to the side? And it's a huge question, I think, for the ecosystem. And on top of that, because most of the ecosystems have been built off of, call it structured data, with generative AI, all the value is in the unstructured data. So if you're an ecosystem provider, you want to be thinking about, how do I tap into that 70, 80, 90% of data that's inside of the bank that I'm not seeing right now to make my experience and my product better? And that's where the real value is going to be, and hence the innovator's dilemma that they face. What made them successful, being really good around structured data and deterministic, may not make them successful in the future when you need to tap into all this unstructured data and information.
Given that, is it possible that, we talk about open banking, and I kid the fact that, at least in the U.S., a lot of consumers have built their own open banking relationships. I know that I have, where I have different providers that provide different services, and I've combined them to be able to look at them as a whole, as opposed to my bank, which in the U.K. is much more likely to take on that role. When you're looking at agentic AI, where you have a digital agent, will the banks be holding that digital agent to help me? Or will I be forced to maybe make a relationship with maybe a fintech provider, or maybe build it myself, where I actually have an agent that works on my behalf, and the banks are closed out of that actual advantage they could have had?
Your question about agentic agents is, I think, is a really important one for the banks to ask right now, especially with open banking. With open banking now, you can see a future where third parties will develop agentic agents that will build the best bank for you. And so in this year's report, we talked about the need to move from product silos to inseparably connected products, meaning that if banks do not bring the products together and give you a reason to keep your deposit account with your savings, with your credit card, with your mortgage, and give you value for the totality of the assets and liabilities that you bring to them, they are very much at risk of being picked apart by agents that will simply build you the best bank going forward. So it is a paradox for the bank. If you may be able to build it yourself, but the reality is third parties will build it. And the way to counter that is to integrate your products in such a way that you give the customers no reason to go anywhere else. And by the way, when we did this research around the world, we found that less than 15% of the banks provide a customer-centric product model, meaning most of them simply expose their product silos to the customer, exposing them to open banking and to agents, arbitraging them in the future. It is a huge product development issue for them.
Well, and it's interesting when you talk about the back office and actually tracking the impact of that. It amazes me how few financial institutions have any idea what percentage of the overall relationship they still hold. They all sit there and feel really good that no customers, there's been very low attrition. That's actually gone down over the years. Well, the reality is very few people close a major relationship, but they do open a number of other relationships. And we find this in surveys we do across the entire industry. And yet nobody really manages, very few manage what's going on in the flow of funds, what's going on from the share of mindset and the whole relationship. And that's very critical, because what happens is you're giving a falsehood around the loyalty and the value of the relationship overall. So, one thing also that your report talks about is that scale seems to be more critical than ever. Does this mean that regional or smaller banks may be at a disadvantage? Or, going back to our previous question around technology partners, are smaller banks and mid-sized banks really in a pretty good place against the bigger players when it comes to being able to provide the digital relationship and the digital engagement and experience that the big banks can do?
Yeah, and when we looked at that report, what we realized was, and when you look at it around the world, right, when you look at consumer banking and especially commercial banking, which was a big part of that trend, scale is going to matter because you need to be able to follow these large corporates all the way around the world and that side of it, and then brands matter on that side. But Jim, we also believe fundamentally that community and small banking has a huge role to play. And if they adopt this technology because it's being democratized and being made simply available, they should have a great advantage. And in fact, in many ways, still having a branch in a small town. I grew up in a really small town in upstate New York on a farm. I still have my bank account with the original bank that I had when they gave it to me when I was in kindergarten, and I still keep money in there to this day, right? So I think community banking has a huge role to play, and I do believe the democratization of this technology will give them a great way to tap into it. But at the same time, on a global basis, scale matters, right?
It does certainly, but it's interesting because we've alluded to this today, but we also talked about in previous meetings on the annual report, is that where the real difference in management style, leadership comes from, is some of these smaller community financial institutions. They're much more willing to step out there and try new things because, their whole existence depends on it. But it's interesting because some of these small organizations are doing great things out there in a way that mid-sized and large organizations really struggle with because of the layers, but also because of the legacy mindset that really prevails against everything else that goes on. So we were talking a lot about the inner and outer workings of financial institutions and how they're going to change over the next 5 years. We discussed how important AI is going to be to humanize the experience and how the organizations that succeed are really going to need to dig deeper in the data and provide an empathetic and personalized experience. However, not everything always is peaches and cream, as they say. The report that you developed this year highlights how regulators' efforts to eliminate risk could actually create new risk by pushing activities to non-banks. How should banks respond to this challenge?
Yeah, and Jim, it is one of the trends that we noticed this year, and especially in the private credit segment. So as regulators have increasingly pushed to kind of eliminate risk in the banking system, banking's like a balloon. It's just simply squeezing it in one place, but it's going somewhere else. And in this case, we highlighted a few things. One is what's occurring in the private credit space. We see also what's occurring in the mortgage spaces, both in the U.S. again and overseas, and how these larger transaction values are being pushed outside of the bank. And what we're seeing banks, kind of accept that the regulators may be diminishing the risk they can take and partnering up. You saw Citibank partner with Apollo on the private credit space in many ways. So I think what you're going to see is you're going to see banks ask themselves the questions, where do I have a strategic advantage? And what you see when we look through the research was we saw a few places. One, in consumer banking, it's highly regulated. It's unlikely that competitors are going to be able to come into that. Second, in commercial transactions, small business banking, it's, again, highly regulated. Unlikely that competitors are going to be able to come into transaction banking. But in commercial lending, you may want to start looking at partnering. So that's where we're starting to see these questions come up. And that's what banks are asking themselves the question, which part of my business and my profit pools are more durable and which ones are likely to be attacked? And I would say the ones most likely to be attacked are the ones where a few people in a spreadsheet can do a deal, and the capital markets are emerging in such a way that they can do that lending. But depository and transaction banking is almost unassailable, is our conclusion.
So as you peel back the layers, as we talk about 2030, we talked about it many times, the experiences will go back to the future. What do you think will be the optimal blend of digital convenience and efficiency and the personal service and engagement? What will that look like in 2030 from your perspective?
Yeah, what I believe it won't even be a blend. It'll be seamless. It'll be a completely connected experience. So, Jim, if you were my banker, I might be talking to you. Generative AI will remember the conversation. And when I go to text, it'll just bring it back and forth. So what it'll feel like anytime I have a conversation, it'll feel like a continuity of that conversation, regardless of what channel I go to after that occurs. And what I believe will happen, and this may be a little controversial, is you will actually end up talking to people more than you are now. Because what will happen is you'll see this idea of what I described here as waste out, value in, meaning you will take the wasted part of the processes out that are really non-value add. Think of it like a relationship manager filling out forms after a conversation. That goes away, opening up more time for the relationship manager to have more conversations, to text back and forth. And we'll blend those channels together with the humans in such a way that we'll actually have more conversations directly with people rather than less, and more meaningful.
It's interesting.
I'm an optimist.
Yeah, go ahead.
I'm an optimist.
It's funny. You took the words right out of my mouth. We tend to, near the end of our conversations every year, we start talking aspirational. We start talking on a very optimistic level. You're talking the way you talk to clients. I talk the way I try to recommend to listeners and to followers on what they should do. In the next 5 years, what will get in the way of being able to achieve what we both know is not impossible to achieve?
Culture. And you mentioned it earlier, Jim, the culture of not taking risks, right? Of not being curious, of not trying new things, of not learning how to use Excel in 1980. If you were in a bank and you didn't learn how to use Excel in 1980, you're probably not around today. I think that is the biggest challenge that's going to be out there, is the culture of not taking risks, especially as we come out of the great financial crisis and we've tried to zero out risk in banks. Banks need to get curious again. That, I think, is going to be the biggest challenge. And I will tell you on a private note, right? When you look at this, banks that I go into that I know are super smart and just ask me question after question after question, and I know they know more than me, but they ask those questions, Jim, they have the highest price to book ratios. The ones where I go in and I give them an idea and they say, I did that 3 years ago. And I'm like, well, it really didn't exist 3 years ago. But okay, the arrogance, they have the lowest price to book ratios. Curiosity, I think, will win.
Or the belief that the sky is not really falling, because we've proven it. Heck, we've proven it both for our whole careers. We keep on saying the sky is falling, and it's never fallen. They continue to make money. So it's one of these things, what are you going to commit to? And it's interesting because you mentioned the Excel. And today you don't have to learn how to do Excel because the AI tool will do it for you. But your ability, your prompting skills, generative AI in November of 2022 should have taught everybody, or at least people that are interested, that it's how you ask the questions that's going to determine how well the answers will come out and how close to what the reality will be. And I'll tell you, every single day I get into a ChatGPT or a Claude AI or another AI tool and try to test my ability to ask questions to get the answers I want. I'm getting really good at it. And as you said, what's really nice is the tool learns about what I've asked in the past, so it holds on to what I've learned also, which is really good. What's challenging, and it continues to be challenging, is just not just culture, it's complacency. It's the fact that, okay, what's the risk if I don't do it right? Which is what really sets the small organizations apart from the larger ones, because the smaller ones really do feel threatened, and they really do internally want to help their members or their customers I think more than anybody else because they're closer. There's less layers. But it's going to be interesting because prompting skills, the ability to take the data you have and help people with that. For the tellers, I walk into a branch to take the decomposed and the decentralized insight, and they look and they say, Jim Marous just walked into the branch. We have that because we have the ring around the branch to say who's coming in. I'm going to be able to help him because it's going to prompt me immediately to what should I talk about to Jim right now. But there's so many organizations that will simply do transactions in the branch. And we can always already tell that. And some organizations are actually building a culture around, we're going to do banking the way we've always done it. You're not going to have to worry about risk with us. And I'm going like, geez, I'm not too sure if that's what I want my bank to be. When you look at all of your trends and you look at the banking industry and in a mass, what is the single most important action that leaders must take today to position them for 2030?
I'll come back to the talent. And I would say if there's one thing that's going to really change, I think the way is thinking through the future of interactions. Because as we've gone through this digital experience and we've digitized everything, Jim, as we mentioned at the front end of the broadcast, we have outsourced everything to our customers. They should be thinking about how am I going to use this technology to change those experiences in such a way that I bring the past back into the future of what I'm going to do. Because it is those relationships and those experiences that create durable brand over time. Right? That's the number one thing I would say you'd want to be looking at right now. And it will drive back. It'll drive you into asking your product questions, your tech questions, your op questions. It'll drive you everywhere. But it's the future of how the experience and interaction, the bank's going to work. And I think setting a simple bar like interacting with us should be as simple as texting with your friend is not a bad bar.
Okay. And so I'm going to put you on the spot, but I'm going to give you some flexibility. And that's going to be what organizations out there, banking or otherwise, are the furthest along in the whole idea of being able to personalize the experiences, build better engagements, differentiate from their peers. What are some organizations out there? They don't have to be clients. Just as you see it as a consumer, what are organizations that you see, as I said, banking or otherwise, that really seem to get it? They're doing the right things, not just saying the right things.
Yeah, I think when you look at that, you look at any of these industries that are very consumer oriented, and whether it be the likes of your Spotify's of the world, right? Or frankly, when you get a car, you bring up Google Maps and it says, "Are you driving home?" What they've done is they make the technology think for you. They use the technology to help you think ahead and think for you. And those experiences feel like a continuity of conversation over time, space, and everything that you've done. It remembers what you did. It makes recommendations that are highly relevant, and it's integrated very seamlessly. As you know, Uber, the app actually changes depending on where you are and what you're doing, right? They modify the experience. They make it very dynamic. And you don't see it, but it just feels like an extension of you. So I think these direct-to-consumer businesses that have come out of Silicon Valley, in many ways, probably are already setting the bar and are a good place to look.
It's interesting. I was just as we were talking, I'm thinking, what would my answer to that question be that I just gave you? And to me, it's the athletic shoe companies. There is so much competition in the athletic shoes, and so many people collect them, and it becomes part of their personal brand. I know for me, I never would think I'd have so many different types of athletic shoes and shoes in my closet, but it depends on my mood. And what's interesting is they can customize the shoe to my liking, or they'll simply know what I usually like, and they'll text me and say, by the way, we have a new series of things coming out that you may be interested in. And all of a sudden I'm looking going, yeah, they kind of got that right. And they're really good on the customer care. And what's interesting, what used to make them special, how good of an athletic shoe are they, is less important than adding that to how much does it reflect who I am as a person. And, a financial institution can do that. Uber does that. Uber, I give the example quite a bit when I visit overseas, how Uber, from my beginning of a pickup in an airport to my drop off at a hotel, continues to engage with me to get me to do more things that will probably require either Uber Eats or an Uber delivery or an Uber drive to another place. But it's interesting because it continues to learn as we're engaging. And, because we don't always engage, it doesn't always communicate with me. But when it does, it doubles down on that communication.
So let me try to bring you from sneakers to banking on that exact analogy, right? I don't know, Jim, if you've seen it, but there's companies out there that are building sneakers that they will literally paint them to your feet, personalized, customized, one-to-one sneakers that will be built with 3D modeling. You put your feet out there, you go in, and they'll build the sneaker personally for you. I think you need to look into that one.
You got to send me a link to that one. That by itself is a talking point at a conference, if nothing else.
So you've got that, but then let's take that to banking. Banking should be a product of one, right? Ultimately, it's the same analogy, right? We should be getting to the point where, exactly as you say, it feels like the product was customized and built for me. Whether it might be a mortgage that offsets the interest rate based on the deposits you keep in there, that gives you a higher cash back, rewards, but all of that should be wrapped in. That should be the future, exactly like your sneaker example. The problem is right now, we're still selling Model Ts in banking for the most part. We haven't even changed the color.
We still dummy it down, and to coin Don Peppers and Martha Rogers from 30 some years ago, we're looking for the one-to-one future. It's very key. Mike, I appreciate you being on the show. It's a good time of the year, and as we talked about before we got on the air, we're going to make sure we do an interim, and it'll be a little different type of podcast. We're going to do it on the road, as they say, but we're going to keep that a secret. But we're so close to each other this time of the year, we'll make sure we get together before I head up north again. Thank you so much, Mike, for being on the show again.
Thank you, Jim. Always a pleasure.
Thanks for listening to Banking Transformed, the winner of 3 international awards for podcast excellence. If you enjoy our work, please give us a positive review. Finally, check out my recent articles on the financial brand and our fantastic research that we're doing for the Digital Banking Report. This has been a production of the Evergreen Podcast. A special thank you to our senior producer, Leah Hassage, audio engineer, Chris Fafalius, and video producer, Will Pritz. If you've not already done so, remember to subscribe to Banking Transformed on both your favorite podcast app and on YouTube for more thought-provoking discussions on the intersection of finance, technology, and leadership.